Welcome to another episode of Can I Retire? Hi, I'm Tony Hansman. If we haven't met, we're with Guardian Financial, a wealth management firm, and we help people who are in or near retirement. Stay with me till the very end. I've got 3 great tips to help you in your retirement planning. So let's take a look at our hypothetical case right now, jumping in right into it. Today we've got Tim and Faith hypothetical. They're both currently ages 64 years of age, and they're going to live to age 95. They know that they have long longevity on their life. They are exercising, they're taking care of themselves, and let's take a look at what's going to happen for these folks here. So we're going to come down here, we're going to hit the next button and take a look at their needs, wants, and wishes. Currently, they have needs of $60,000 a year, about $5,000 a month. To be very clear, Tim has $3,000 of Social Security, and his wife Faith has $2,000 of Social Security income turned on. So they're living on their Social Security. They are not going to touch their assets. They don't need to in this particular case. Now, if we take a look at their wants, they're kind of in this go-go phase of their life, to where they do want to do some traveling while they're still young, and we classified them of having about $10,000 a year to do those trips. And then they have wishes, and wishes are they're going to need a car in their near future. We've calculated inflation in here for them already, but please remember in this hypothetical case is that they're living off of their Social Security. They do not need to use their assets except to dip in for a little bit of traveling expenses. So let's go ahead and jump over to their asset screen and take a look at where they stand. Now we're on Tim and Faith's asset page. Let's take a look at this together. So you can see they have 5 different accounts. Tim has a Roth of $25,000. Faith has a Roth of $25,000. They have a joint taxable account of $250,000. Faith has an IRA of $200,000, and Tim has an IRA of $400,000. A total liquid asset of $900,000. Now, I threw in a house of $500,000. They're paid for, 0 debt for this couple. But I want to point out something that's really important right here. This is your first valuable tip in this lesson today. And that is, in this particular case, 5 different accounts. And what we found, and it's very common, is that they have the same mutual funds in all 5 different accounts. So what I want you to do is put this video on pause. Go get your statements, put them out on the table, and take a look at the different funds that you have in each one of these different accounts. Do you have the same mutual funds? One way to look at it is they'll say something like VFIAX. Most mutual funds will end in an X. Or if you have ETFs or whatever they are, you're simply looking at each portfolio and see if they are aligned or they're well diversified. Do you have the same funds in the exact same portfolios? That's usually a warning sign that somebody's fallen asleep at the wheel. It makes much better sense most of the time to have those diversified, especially since these accounts are taxed differently. So that's your first big lesson, is go take a look and see if you've got the same funds in all 5 different portfolios. You don't want this to happen. So now let's go ahead and jump over to the next screen. Tip number 2, here we go, is knowing your personal risk score. I can't tell you how often I ask people and say, hey, listen, where are you currently at in your risk tolerance? And I find most people will say, Tony, I'm not super conservative, I'm not super aggressive, I'm kind of somewhere in the middle. That's a little dangerous in my opinion, not knowing your specific risk score. If you know your specific risk score, it can give you a higher probability of what the upside potential is, and more importantly, what the downside potential is. I like surprises in my birthday, but not in my financial plan. So when we ask Tim and Faith their scores, Tim has a score, Faith has a different score, but this is their household score. Now, this household score is a little higher than what I normally see. They're 64 years of age, but they're taking good care of themselves. They understand how the market works. They're in it for the long run. They don't mind if there's big pullbacks. They may become a little more diversified as they get a little bit older, but they know and they feel like they've got at least another 30 years of life expectancy. Since they're living just off of their Social Security amount and they're not touching these assets, they're okay with a little bit more volatility at this young age. Yes, 64 to me is still super young. So if they've got 30 plus years, they believe in it, they're okay with taking a little bit more aggressive account. So if we take a look at this, you can see they score out an 87. Now, We use a different software to ask these folks all their risk questionnaires to make sure that they get this risk score. You can go out to our website and get your own score, but I can't tell you how important it is to know what your risk score is versus just simply saying, I'm somewhere in the middle. So now let's go ahead and jump over to the next screen now that we know their current score. Now in this hypothetical case, we're back on Tim and Faith's current scenario. So we're going to hit this Run 1000 Trials button, and it's going to show us the probability of success if they will ever outlive their money. And they score a 99, meaning that's the highest probability that they're not going to outlive their money. Remember, they're living off of the Social Security, not dipping into assets. So I figured they're going to have a great score. I'm not worried about this couple at all. Now, people will argue and say, well, I think Social Security is going to go bankrupt. That's a completely different case. Then they would have to dip into assets or something like that. So we're going to hit this next button down here, and we're going to go over to the next stage and take a look at their recommended scenario. And when that's coming up right now, you can see they're still at a 99. I want to take a look at this risk and reward button, and I want to show you something that's really important. So as this is up, you're going to see is since they're not touching their current assets, they could be in a very conservative portfolio and be just fine. They could also be in a pretty aggressive portfolio and still be just fine. It's not going to make that big of a difference. You can see their probability of success at the very top in a capital preservation portfolio is 99. And all of the portfolios all the way down to the bottom in a most aggressive account is still 99. Because we're making sure their score is based on will they ever outlive money? No, they're living off of their Social Security. So if they wanted to, they could be a little bit more aggressive. And in this particular case, and at this young age, they want to be. Again, they may reduce their portfolio risk as they get a little bit older, but as of right now, they're okay with this risk tolerance. Another reason why you have to know what your current score is. So we're going to jump over to the next screen and be right back. Okay, so here we are on the next screen. Number one is, remember, make sure that you don't have the same mutual funds or ETFs or the same investments in multiple different accounts. Number two is knowing your risk score. You can go out to our website and make sure that you get your own specific risk score. You don't want to be guessing and just thinking that you're somewhere moderate, aggressive, or somewhere in the middle. And number three is I often find that people want help with that they're not getting from their financial advisors or their accountants or EAs or CPAs is tax planning. So let's take a look at a 30,000-foot overview of their tax situation. Here we're back on Tim and Faith's situation. You can see the blue line represents their Social Security. They got some cost of living adjustment. So as I scroll forward, you can see that cost of living adjustment or that Social Security is going up just a little bit. The green line represents once they hit RMD age, required minimum distribution, they have to start taking money out of their IRAs. Now, if they don't take this money out, there could be a hefty penalty, and sometimes, depending on what bracket that they're in today's environment, is up to 85% of their Social Security can become taxable based on these big withdrawals coming out. So can we prevent this? Can we save them any money in tax planning? So what I'm going to do is I'm going to come down here to the bottom and I'm going to throw in a couple Roth conversions for Tim and Faith. I've set this up. What I did is I did Roth conversions over a 5-year period. By no means am I saying that you should be doing Roth conversions over a 5-year period. No means am I saying or recommending that you need to be doing Roth conversions at all. If you think that taxes are going to be lower in the future, then maybe tax planning or Roth conversions makes no sense to you. The laws change every year. Life changes. You need to be looking at this and analyzing it with a professional every year to make sure that Roth conversions make sense for you. For some folks, it doesn't. So I simply did this over a 5-year period, and you can see we took all the accounts, we pushed them all the way up into a 22% tax bracket. I just made it up. For some people, it's for 10, maybe it's only a 12% bracket. It's different for everybody. This is totally hypothetical. So we converted the entire amount over 5 years, and you can see they no longer have any sort of required minimum distributions. All of these accounts now are going to grow tax-free for themselves, that they could take out money of these accounts completely tax-free, and when they pass away, this money would go to their loved ones tax-free. So from a 30,000-foot view, a quick analysis shows me that they have a lifetime tax savings of about $175,000. We use additional tax software besides this one here. This is just kind of a quick synopsis of if it would make sense for them or not. And then to have that dialogue to see if it would make any sense to do some Roth conversions. So you can see a dramatic change over their lifetime of the potential tax savings. And there's a lot of variables going on in there, so make sure you're working with the right professional. So in summary, just to recap, number one for the value tips today are make sure that you don't have the same investments in every single one of your accounts. Most of the time, that's a big no-no. Number two, know your risk score. I can't tell you how important that is to know. Just guessing that you think that you're in this moderate range is not ideal. You want to know a highest probability of your upside potential and, more importantly, your downside potential. And number three, get tax planning. Most financial advisors, a lot of CPAs just don't do it. Just find someone who can help you out. And as remember, always consult a licensed professional who understands your specific goals and dreams.